All right, hello, and welcome to yet another Value Podcast. Happy holidays. I'm happy to be back. I can't wait for the New Year podcast. We're kicking it off with a banger. Today, I have Judd Arnold from Lake Cornelia Capital. We have a wide-ranging conversation about a whole bunch of stuff. We were actually supposed to talk about the death of Vegas, Caesars, gambling, casinos. We talk about so much stuff, we don't even get there, but you are going to enjoy it. We're going to talk a little bit of theory, sizing up into inflection points. He's going to give the pitch for TOI. We're going to talk just all sorts of stuff. I really enjoy this conversation. I think you're going to too. Judd just launched the Lake Cornelia Capital Substack. I'll include a link in the show notes. But if you enjoy this pod, you'll probably really enjoy subscribing to that too. So we're going to get there in 1 second. But first, a word from our sponsors. Today's podcast is sponsored by trytrada.com. Look, you've heard me mention Trada multiple times over the past few months on the podcast, and it's because it's a product I really like. Trada is two buy-siders getting together onto an anonymized transcript. They talk about a stock that they know well, and sometimes it's a bull and a bear, sometimes it's a bear and a bear, sometimes it's bull and a bull, but they're going to talk about it. The reason I like the product so much is it's interesting on two angles. A, if you're ramping up on a company, a stock, whatever, and you want to go talk to someone else who's following the stock deeply, you can do a call and you can learn really quickly about it. But B, my favorite thing about it is when they've got a transcript on a company that you're ramping up on, that you're following, you can go and see what two sharp buy-siders are looking at, thinking about all the risk, all the opportunities, everything. Here's the best review I can give them. I've been pitching this for about 4 months. I get feedback from my viewers on the things that I put on the podcast. And the most frequent feedback from people who've tried Trada I get is, hey, man, I really like the product. My one complaint is they don't cover enough of my stocks. I hate it when I'm following, researching, doing anything on a stock, and they don't have a coverage on it. I need more coverage of Trada. If that doesn't speak to the product, I don't know what else will. Look, this podcast, we were supposed to talk about Caesars. The ticker there is CZR. Me and Judd just ramble. We don't get to Caesars. But guess what? Trada's got the hook for you. If you want to read a buy-side transcript of what's going on at Caesars and digital and gaming and all this sort of stuff, go to trytrada.com/CZR. That's trytrada, TRATA.com/CZR. And they've got an anonymized link that you can go read what Trada is all about, read up on Caesars, all that sort of stuff. So thank you to Trada for sponsoring this podcast. Go check them out. All right. Hello and welcome to yet another Value Podcast. I'm your host, Andrew Walker. With me today, I'm happy to have one of the people's favorite guests based on the viewership metrics, the amount of response on Twitter. My God. But Judd Arnold from Lake Cornelia Capital. Judd, how's it going?
Great to be here. Happy New Year. And congratulations to you, new father.
Double father. Double father. Yep.
Man-to-man defense still.
Oh my God, it's a lot. Well, we don't have to talk about that. Before we get started, quick disclaimer, remind everyone, nothing on this podcast is investing advice. Judd and I have, I think we had a list of like 7 stocks. We were talking through 3 of them before. So we're going to talk about a lot, but just remember, not investing advice. Please consult a financial advisor, do your own work, all that sort of stuff. Judd, you have had the glorious launch. The Twitter account was basically dormant for a month and then for a year. And then you came out and you've had the glorious launch of Lake Cornelia, the Substack. I'll include a link in the show notes. Just on fire in terms of 4,000 page memos. I mean, my God, people tell me, Andrew, I don't know how you do so much. You're publishing like 4,000 page memos a week, it feels like. But we've got lots to talk about. I wanted to talk Vegas. I wanted to talk TOI, but I'll toss it over to you. You're publishing on everything. Where do you want to start? What do you want to talk about?
We can go wherever you want. I think the Substack is something I've been thinking about for a while. And I think the transition big picture that I made was, I left hedge funds at the start of 2020 and with like plan unknown. And during COVID, very rapidly, I had a few people reach out saying, will you work here? I didn't want to work for anybody ever again. So I offered to be a consultant. And that was kind of my business for almost 5 years, and which had a lot of positives. And I'm still doing that with a few clients. One of the negatives that always bothered me, which was something that bothered me going throughout my whole hedge fund career, and this is something a lot of senior analysts talk through, which is it's really hard to pitch a boss or a client something that's obvious. You have to be unique. You have to be like, I have this unique insight. That's always better. And I think generally that's been nice, but it also put me in a box of like a mistake I've made historically is doing stuff that's too cute by half or just a little bit too fancy, too illiquid and whatnot. And I just had this moment of like, I write a lot of stuff. People like what I read. What if I do a Substack where I just say, this is interesting? And I think the other aspect of this is interesting, and this is another thing for senior analyst that like it was illuminating. I used to have about 10 clients that would pay me for the consulting thing. What I found, and it was so nuts because I go back through my career, I worked at three of the biggest funds out there. As a senior analyst, you pitch an idea to the PM. What's your probability of the PM caring? Usually 10 to 20%. The position being put on, like 5%, less than 5. It's really hard. When I had 10 clients, I could see this in real time. So at least every idea I pitched, I'd have one or two people that cared and would follow through. But then I sort of had this second hand epiphany, and this was something a friend of mine who I've worked with at two funds brought up to me. And this just sort of goes to like the business of what we do, which is we don't know which names are going to work. Okay. So people would pay me for like, I just want to hear what you're doing, even if it's not what I'm doing. And one of my friends, he said, I went through all my numbers for the last 3 years. When I was high conviction, only 1 in 4 or 1 in 5 times would the thing actually work. So I think what I should do with my book is have, these junior varsity positions, and then I'll ramp up when it's starting to play out. And that's sort of high conviction inflection investing. And that's what it is. So all of this is sort of merged together. I'm really liking this Substack thing. I deeply appreciate the response. I'm like super thrilled with how it's impacting me in my investment process, which is I feel like less pressure to be unique, but also do stuff that's interesting.
Okay. Everything we were going to talk about before. You said, I don't know if you saw, I was taking a lot of notes. You said a few things that really struck a chord for just things I've been thinking about and everything. So we're going to talk about those, and then we'll come back to Vegas and everything else if we get a chance. Let me start with, you said, let's start with the 2Q by half. So one thing I have really been thinking about is, hey, the 2Q by half versus simple, right? And the simple to me is historically, I really liked the financial engineering stories, right? Hey, we've got this thing. It's going to be a 2% top line grower. It trades for 10 times free cash flow. They're going to buy back. All the cash flow goes to share buybacks. And, the famous financial levered buyback story, as they grow, they take on more debt so that you get even more. Like, I used to love that story. I don't think any of them have worked over the past 10 years. And I would say that's an example of simple versus some of the stuff you and I have talked about or done, like, hey, this is a de-SPAC that went insane. The private equity sponsor needs to sell all their shares. The company, 3 of the 4 divisions are absolute garbage and they're going to have to shut them down. But this one good company, if they can just like refi everything, it's going to the moon. Like, that's a really hairy story. And I think 10 years ago, I leaned towards the simple stories. And now I lean towards the more complex stories, but then I come back and I'm like, damn, these more complex stories will rip your face off when you get them wrong. So I'd love to just hear how you're thinking about it. You've been in a lot of this stuff.
I would add one more continuum to what you said, because the other thing that sort of looped into this, and they go hand in hand, is liquidity. And for every name that's worked for me, it's gotten really liquid. And I have too many names I found where I'm fighting the battle of will it get liquid, and I'm buying it illiquid, hoping that like I'll get the mega payoff when it becomes liquid. And you do the inverse of that, and you're like, what if I go just to the next level up where I trade valuation obviousness? Because that's really what I was doing, which is the less liquid names, the valuation was like transparently cheap, where the more liquid comparable names, and I'll give a few examples of this, the valuation wasn't as obviously cheap, but it was already liquid. Okay. So, and I'll give, a few examples of both, right? Like Mixed-T, which became Powerfleet, which became AIoT, never really got liquid. Okay. It's still obviously very cheap. Well, I don't know if it's obviously very cheap because the stock's kind of gone sideways, but you can like on traditional valuation metrics, you're like, okay, 7-8 times EBITDA, like this thing could trade for 20 times, blah, 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 blah. All right. I looked at like, and it really crystallized for me with Nimbus or Nebius and NBIS.
Look, you are the one, if I can hop in here, you are the one who told me about Nebius, a few other people. I can't think of a stock that I have traded more poorly. Like if I had just bought it when we talked about it, and I did, and never sold a share, I'd be a lot bigger office that I'm talking to you. And that stock just infuriates me.
With Nebius, you could push back on everything. Okay. And we started talking about this at 18, and like I really had a chance to lean in at 20. Okay. And that was after the venture capital funds came in. This was post-tariff, and like you could really lean in. The number one thing I would say to people when I was talking about it is I'm 100% certain that people will care. was trading like 1 to 2 million shares out of the gate. I was like, this is going to be a QQQ, like highly liquid, trades 25 million shares a day. It's just like you have too many pieces with Arcaday, and like a management team that's known. You have all these pieces, and it became super liquid. And so if something is already liquid or you're high conviction on it being liquid and the growth story is somewhat tangible, and not hard. And I put ASATs in this bucket too, which is ASTS, which is one I'm not involved with, but it's one like I look back over the last 5 years. It's one like when they got that first contract and it ripped to 5 and came back to 4, like 2 days later, and the warrants were at 1. I'm like, people care. This thing can go to 50 to 100. People would say, how are you getting there? I go, I don't know. I just know it's going to 50 or 100. And it's liquid as all get out. And so, TE is an example, which is T1 Energy, which was Fryer. And we're like, I have 2 notes on my Substack about it. It's a solar name, but it's one where like I came to it. I'm like, I knew this at DSPAC. It was always a liquid one. It's liquid still. Now we have a story. This is worth my time exponentially more than the other stuff.
So if I could just, so it sounds to me liquidity, like you're really talking about liquidity, things that trade. And I like how you framed it, things that people care about, right? ASTS, whether you believe the technology or not, and I know people on both sides of that, of believing the tech and the optionality there, whether you believe it or not, it's space communications. People are going to care. NBIS, it is data center, cloud data center for AI, right? Yeah. People are going to care if you get it. How do you think about people are going to care? TOI, which I've done some work on and we might talk about later. That probably fits nicely. There's a lot of shares out there. They had a big private equity sponsor give out shares to LPs, which is obviously a disaster. People probably care if it works, but it's a weird business model.
Less so. And I like healthcare services. What I'll say is when you're right, they're always going to care. I feel convicted enough. Like, and the care there though is you have to get more granular, which is it's a 20% grower in healthcare services that has a fixed capital structure and a multi-year, 5-10-year massive like size to TAM and high quality business. Like if they can execute, people will care. They're gonna show up.
Let me ask the liquidity question a different way. When you said ASTS and NBIS, I think what I hear a little bit is, hey, I'm looking for the story before it inflects or as it inflects, right? And that's an interesting style of trading, but it doesn't have anything with valuation or fundamentals. So are you like kind of increasingly divorced from that, where you're just trying to find, hey, I want the story before it inflects? And like, I know people who they want the story before it inflects, and then it inflects and they sell, and maybe it's a zero long-term, but they, they're out before it goes. It went from 40 to 200 to zero, and they're out at 150, 160.
I would add one piece to that, which is critically important, which is, yes, I'm less tethered to traditional valuation metrics, and more tethered towards story and liquidity.
Okay.
But because I think my advantage is an ability to move quickly and to appreciate things that have a big, I think is right tail the good one or is left tail the good one?
Right tail is generally the good one, but hey,
I know.
10% of the world's
right
left tail. Why
things
can't it be left tail?
Huge right tail. So like, let's go back. Like I started on this journey really, leaving traditional valuation stuff and thinking more conceptually about like just the nature of inflection investing. Really, I'll say in 2017, 2018 at my last hedge fund when I had to start looking at capital market stuff, because I started the first 8-9 years of my career were in distressed debt. And I was the energy commodity shipping. Like, believe me, I was as tethered to valuation.
No, I was pulling up I was prepping for this podcast and I pulled up and I saw, a fund in 2013 files a 13D and says, hey, Judd Arnold will be resigning from this board. And I was like, oh, that was a distressed debt board. See, like that's distressed debt.
This was DHT, the shipping one. But which was I still remember you were buying 10-year-old BLCCs for $11 million. And it was just like, you're buying them at scrap. But I thought like really getting on my own and leaving in 2020 and leaving hedge funds completely, you lose. And this really goes to like the nature of like what I do. And the more people I meet sort of on this journey of like, it's mostly people who run money, just their own money. It's like hard to get other people's money to do this but it's names that like are hard to pitch, but you want to pitch them. So like, and I just keep going back, like NBIS, there's no person I pitch that to that said, this is a terrible idea. Every single person was like, it's awesome. Like, help me with the sum of the parts story, because that's what I can lean on to pitch my boss.
Yeah.
Like I can pitch downside. And like ASTS is another one. And WGS I would throw into this bucket, which is this exome company and genome company that went bottomed at like 2 and went to, I think it's at 140 right now. It's another one.
The way I've kind of thought about this, you can tell me if I'm wrong. This might be too married to fundamentals, but what you don't want a stock, as I said at the beginning, that's trading at 10 times price to earnings, right? Because that is the quants, the computers, they're all over that. That's fairly priced. What you want is, I'm sure you're at least somewhat familiar with Talon, TLN. This is a company that, to very much simplify it for viewers, they own a big nuke out in PJM, right? And what you want is somewhere where, hey, the financials mean nothing, right? It has a 500 megawatt nuke or whatever, and what you want is a place where the financials mean nothing, because all of a sudden the demand for megawatts is going up, and it's hit that inflection, and you'll never see it in the financials trailing, but like the megawatts are just like infinite money printing machines. I don't know if that quite made sense, but that's like how
it does. And I would go further on that topic, which is, I mean, Talon is the spinoff from PPL. PPL was my biggest equity position in my first hedge fund. It like made the start of my career. I've been to that plant. It's awesome. And when it came out, I looked at this and I was like, power hasn't worked. I was like, that power was my original sector.
Do you want to know why I didn't like it? Say, I did distress that. I was involved in TXU and a few others. And when it came out and I had all these generalists pitching it to me, I was like, you guys have no effing clue how hard this is. Like, all of these go bankrupt every 7 years. Maybe you catch a cycle. Never thought you'd catch a cycle
So that's where I was sort of going, which is, you covered power for a while. How many years did we watch with Vistra? Oh, it's a 20% free cash flow yield, and like all this stuff. Like, and I literally moved away from power. It was where I started in investment banking. I've been to more power plants in this country than anybody probably on Wall Street. I bought power plants like in the Calpine bankruptcy, but I don't know where CEG is trading today. CEG is the nuke spinoff from Constellation. Like, last time I looked at that, 35 times earnings. And so then the point I would make, and that was after more than a decade of all these power names, NRG, all this stuff trading at 15 to 20% free cash flow yields, the story being share cannibals. When you get the wave of generalist money coming in and the story changes, you are going to price at something stupid. And, and so what, in terms of focus, I don't know if it's like divorced from reality or valuation reality, but like, I deal in the liquid world. And I think, the first 2 funds I worked at were 15 to 20 billion AUM at the time, single manager funds. You were really restricted on stuff you could buy. You can't play this game of, I think people will care, buy it, have meaningful size, and then exit. Like, you have to actually be correct when you're at that AUM size. When you're running 500 million, $1 billion, like, as long as there's liquidity at the end, like, does it matter if you're not intellectually perfectly correct on a 20-year basis that the terminal value was X? Oh, money flows in. So give yourself credit to call what I'll call skill-based alpha, skill-based sector alpha, which is like a factor when I was at the big pot shop, which is there's single company idiosyncratic. And the decomp, for people who don't, most people get it. The average stock, and there's a wide range, right? 40% of the return is typically the market, 30% is the sector, 30% is the company. So if you can call the sector, that's worth basically the same thing as calling the individual stock. And it's best when you can call both, right? So you're looking for stories where the individual company and the sector are both accreting in value. And when you find that, like, does valuation matter in the whole checklist of the stock decomp? Not really.
One question, what you just said, TOI, and I'm just using TOI, we can talk about it later, but TOI is small enough, and there is sector, right? It's healthcare, there's going to be oncology payments, Medicare, Medicaid, all this sort of stuff, but it's small enough and unique enough. Like, when I think healthcare, I think Pfizer, I think Tenet hospitals, right? When you're dealing with something that's small and a unique-ish business model, do you think sector matters as much? Does it matter just because of the tailwinds? Or when you're doing that, like, to me, I would say, hey, if Judd and I were looking at Tenet Healthcare, I'd probably agree with your 40, 30, 30, and we could split hairs if it's 34, But when you look at TOI, I'd kind of be like, yeah, on a day-to-day basis, maybe it's like probably 40% market for something that's small, 20% sector. But overall, I think like the stock on something like a little, I know you were talking about liquidity, but a little smaller, a little more liquid, with a little more inflection, I think it's actually going to be a lot more stock. Do you think I'm wrong, or did I choose
No,
a
I think you're
unique
right. That's
example?
one of the things I like about TOI and healthcare services in general. And this goes back to why people will always care for a healthcare services name if it's showing it, because you can have these mini, what is the sector for TOI? It's literally a company unto itself. It's still the same process, which is, do they have a story? And I mean, this is where it's like, is it the company or is it the sector? But certainly let's start with market for a second. Economically completely insensitive. Short term, yes, there's market implication, but on a 2-year basis, 90% of the idiosyncratic move of the stock is the stock itself for something like TOI. And that's something you can size a lot more than, a commodity-based company or a consumer retail GDP exposed pro-cyclical thing. So that's one of the reasons why I was able to say to myself, hey, I'm going more liquid, but like, hey, this is a really,
No,
this is one to sort of take that risk. But with TOI, where I really ramped the thing up because I was involved with it, I wrote a lot about it in 2023. And I left the scene in 2024. I round tripped the thing from 35 cents, went up to 220. I got out at 65 cents, and the thing ended up bottoming at 12 cents during tax loss selling last November. And it bounced off, 480 a share a few months ago. It's back today to about, I think, $4 or 420. And we put it, our Substack note that we put out, we think it can be somewhere between 15 and $30 in 2 years. It's still trading under 1x revenue, which is just nuts. But to go from like a reasonable position size to like a full massive ramp into the thing, and I own, somewhere between 2 and 4% of the company. The story of oncology services really, in this multi-year penetration, which is basically with oncology services, they dispense cancer drugs. That's the business. They buy the drugs from the drug distributor, they give them to the cancer patients. You can go into the clinics and get the, fluid chemotherapy, or they'll give you an oral chemotherapy drug like Keytruda. Okay. And they make 15 to 20% margins. What their business model is versus other guys, because about 50% of the patients go get the service via a hospital, and that's the highest cost thing. And about 95% of the ecosystem is fee for service. The next level is all the big 3 drug distributors, McKesson, Cencora, and whatever the AmerisourceBergen is, and Cardinal Health are starting to roll all these up. All the private equity firms are coming in. TPG owns one of the biggest ones called OneOncology. Their business model, this is the drug distributors rolling these up, is saying the fee-for-service benchmark for drugs is ASP, average sales price, plus 6%. That's what you get paid. Well, we're the big 3 drug guys. We can procure at ASP minus 20. And so we can make 20% margins on ASP plus 6 in a fee-for-service model. And we're cheaper than a hospital because we're going to do it all in an outpatient thing. So we're going to be lower than the fee-for-service benchmark on patient services when you come in for your fluid chemo. And then on the drug dispensing, we're going to be really good because we can procure cheaper. What TOI does is one level further, which is they're going to look at this menu of 10 drugs, look at what you're doing. They're like, we're going to service you. We're going to give you, this is sort of a weird way. It's hard for me to describe this without sounding like morbid. Like they're doing what's best for the patient. Don't get me wrong. But like, if you can get the same patient outcome for a $2,000 a year therapy versus $20,000 a year, TOI is like, we're going to do the 2,000. Okay, where the big 3 drug distributors, they want volume, like max volume as much as they can. TOI goes to individual health plans, all the big Medicare Advantage guys, and says, we will be 20% cheaper than fee for service. We'll take this, and the typical Medicare Advantage premium payment per month per member is somewhere between $1,000 and $1,500. The oncology piece is somewhere that TOI touches is somewhere between $30 and $50. TOI goes to a insurance company like Humana is like, we will take that capitated risk on your whole network, all your members, and we're going to lock in $30 PMPMs, and we're going to save you $20 on top of saving you $20 PMPMs. You're not going to have to think about this. We're just going to do the whole thing. We're specialized in this. And so they're really ramping up, as they expand. The business used to be 95% California. California is sort of a weird island into itself in terms of healthcare, because you have all these big physician groups that act as like mini insurance companies. TOI just is really expanding in Florida. So in California, the PMPMs, because the physician groups do most of the stuff in terms of administration, delegation, stuff like that, and credentialing is like $3 PMPMs. In Florida, they're earning $35 PMPMs. And there's a bunch of states like Florida. So 20% margin business, you're seeing product market fit in terms of this new service. They're the only people doing it. You got a new CEO in about 2.5 years ago when the company was really struggling. And he really leaned in, sort of, pulled this out of nowhere. I mean, the company looked like it was going to go under.
Let me jump in. So, all right,
Yeah.
TOI. I thought we were still talking other stuff, but we're talking TOI now. So I've looked at this a few times. And I guess my first thing is, as you said, they're managing the oncology for fee for service. Why can they do this so much cheaper? Like, I understand, hey, nobody's going to argue with me that fee for service, there's tons of fat to be cut, right? Like, as you said, guess what? Just forget everything else. If you give someone a 6% margin, they're incentivized to give you the $20,000 pay drug over the $2,000 drug, just because 6% on 20,000 is worth a heck of a lot more than 6% on 2,000, right? So I totally get that. But why are these the only guys who can do it? Like, why can't someone else do it? Why can't you and I start this up? Why can't the drug distributors, as you said, do it? Why can't the hospitals do it? Like, why are these the only guys who could do this?
Sure. The few levels of this, right? So most of this care is coming through hospitals, okay? And hospitals is like a 2 to 3% margin business. You can go through AI. You can call a million GLG or AlphaSense experts. No one will give me the actual number other than it's material and big part of hospital earnings is dispensing cancer drugs, oncology drugs via their pharmacy. Okay. And so from the highest level at CMS, take something at CMS, Centers for Medicare and Medicaid. Okay. They crack down on scam durable medical equipment. That's where they've gone. Like oxygen's been a big focus. A lot of people you and I know, I don't know if you own it, the Wave.
I thought you were going to mention, I was like, look, I've had a lot of people pitch it. Wound care is a really scary area to me. And I'm not a
so they're a solution to the wound care scam, but CMS is like really going after this wound care, like skin graft thing. Okay. CMS isn't going after oncology drugs because one, it's oncology. They don't want to kill people. Two, the hospitals behind the curtain tell CMS like, hey man, this is like 25, 30% of the total margin of the hospital, which is a 2% margin business, is dispensing oncology drugs. Like if you crack down on this, there's going to be real issues in the healthcare system. So you start at that level. All the big three drug distributors were like, oh, you're going to let hospitals just like charge for the highest drugs and be really expensive for, inpatient? Great. We'll undercut them with outpatient oncology delivery at ASP +6, and we'll just be way cheaper. And it doesn't matter that we're volume based, just trying to pump it, because the fee for service benchmark is set by this insane hospital spend, which CMS is like winking and nodding and letting happen. That's a huge business, right? So if you're anybody but the big three hospital or big three drug distributors, you're like, what can I do? So TPG, when they bought One Oncology 3 years ago, who did they partner with? AmerisourceBergen at the time. Now, they changed the name to Cencora or whatever the heck the company's called, okay? Because all the value is getting the drugs really cheap. TOI doesn't really have competition in the next layer, which they do, which is like, okay, we look at what the big three guys are doing. What if we, instead of prescribe, being really focused on volume, what if we prescribe, a cheaper cocktail of drugs that we know does the same thing? Okay, that's a huge business. Now, what's the negative of it? It doesn't scale as fast because you need to have a great oncologist in every era or in every area that you are. And you need to get oncologists to cooperate with you to like stay on the menu, right? And so the big oncology groups, what they struggle with when people try to do this is like, if you don't own the oncology clinics yourselves and you do it in an MSO model, these oncologists that are in your MSO, they're just not going to cut rate. They're not going to deliver enough value. And this has been the problem for EVH. Evolent Health, which is like a value-based provider, where they don't really control, they don't have any doctors. Their MLR blew out massively. The stock's gone from 35 to 4 over 2 years because they don't have enough control over the network and clinician behavior. So for TOI, you need to have an oncologist you need to build out all these clinics. That takes time. Each oncologist you hire is 6 to 9 months. The aha moment for them was in Florida. They realized because of the market structure of oncologists and patients, they could get leverage over the oncologists and execute an MSO model. So let me start with where MSO doesn't work. TOI is in Nevada, mostly in Las Vegas. Okay. So Las Vegas is just an island. There's 3 million people in that that MSO or metropolitan statistical area. Okay. I don't know. There's like 50 oncologists that matter, right? If you do an MSO network and you don't like what the oncologist is doing, you call them up and you say, I don't like how you're prescribing drugs to all these people. You're doing it way too expensive. Then oncologists can say, well, I control the members. Where else are you going to go? There's not that many oncologists here. I don't have to comply. And whereas in Florida, you have density of patients and you have density of oncologists and you have density of hospital. So you want these areas so it's Florida, Texas, Ohio, and I want to say North Carolina are the markets where you have this convergence of hospitals disproportionately are setting the fee-for-service benchmark. You can get leverage over oncologists because there's enough density and there's enough people in every area. So TOI think they can service areas in Florida and other 3 or 4 other states with only 20% owned clinics and 80% MSO. And that's how you scale. Because if you don't have an MSO network, the scaling is going to be so slow.
You're so much deeper on this than me, but let me ask, I think the question when I was researching it that popped up, I looked at this back in 2021 with the SPAC deck. Their SPAC deck, when they did this, the peers they listed, and the business model is not the same because it's oncology, but it has a lot of rhymes, in terms of, hey, the golden market is Florida. Hey, we're undercutting hospitals. The peers they listed were Cano, Village MD, Oak Street, One Medical, right?
All the primary care guys. Yep. And they all went, I got beat up, but
Yeah. And all of them either ended in tears for their investors or the investors managed to get the bag off to someone, like Oak Street gets bought by CVS. CVS takes a $6 billion write-up. Cano, as you're seeing this, I knew Cano, Barry Sternlicht takes Cano public through his IPO, says the CEO of Cano is the best entrepreneur he's ever seen.
I got hurt on that one. So let's talk about what this thing isn't, okay? There's no MLR risk. Everybody, the MLR variability, these guys are delivering mid-70s MLRs, but it's not like primary care where you can have flu season or this stuff. The biggest driver is drugs. It's drug costs. They know that they're all we have to do, the benchmark is so high. We have this huge gap and we're just going to prescribe these different drugs. And then the second piece is cost was that they've shifted. They were 4-to-1 oncologist versus nurse practitioner. And now they're getting nurse practitioner versus oncologist is getting 1-to-1. So they're saving on labor, but it's a niche business. They screwed up. Part of the other reason is this is a recent pivot over the last 18 months where they shifted to this sort of delegated model in Florida. What they did out of the SPAC is they just said, okay, we're going to land grab across the country. They took SG&A from 40 million to 120 million in 2 years, built out all this capacity, and the patients didn't show up. And they just lit money on, they lit money on fire. Fast forward to this year, or so I'll say 2024, they started adding a lot of contracts. They've got to EBITDA break even in Q4. And now you're going to start getting, 20% incremental margins.
So the gross margin on this business, I looked at that, is 15 or 17%. How do you get 20% incremental margin with 15 or 20%?
So the margin, this is the other piece of how gnarly this thing is. On the capitated business, the margin is 15 to 20%. You have a big fee for service piece in California. All right. But you also, the fastest growing piece of their business this year in Florida is fee for service. Why? They built the clinic, they get the oncologist. While they're waiting for these capitated contracts to come in, they're open for fee for service business. And what they've been stunned with in a pleasant way in Florida was the demand for outpatient, because their service level is so much higher than a hospital and other oncologists, they're getting all this fee for service business in. So as that fee for service capacity transitions, or the capacity transitions from predominantly fee for service in Florida to capitated over the next 2 years, as you start layering in all these contracts, the margin you're going to go on the dispensing side is going to go from ASP plus 6 to full capitated, and on the patient services, which is the in clinic, chemo, IV stuff, and it's also some hematology stuff. That all goes from fee for service to fully capitated. So you're going to win. You're going to get a margin.
I think that all makes sense, though. I will be honest. You're deep into this. It's override. Let me ask the last question. I mean, the same question I would ask when people were pitching Molina Healthcare or all the health insurers. Like, I do all the Medicare health insurers. I do worry, like, hey, even if you're right, CMS is pretty rigid, right? And if they came and they saw this, or the insurance companies, they're like, hey, you guys are all like on all fixed costs and you're making a good profit. Like, we don't care that you're cheaper than the hospitals. We're just taking your rates down, and you can either go pound sand or you can take it. Like, I do worry, like, just like the ruling from on high, if that makes sense.
Yeah, I sort of walked through this on why, like, it's not like durable medical equipment or the skin grafts, because it's a huge piece of hospital earnings.
Yeah.
And, the big three drug distributor roll-ups, like, CMS loves them. They're like, you're saving money. This is great. You're on the right side of this. I think the most telling discussion I've had with the company, I did a site visit. I got to meet the chief medical officer and their head oncologist in Florida. Their head Florida oncologist actually was the oncologist at ChenMed, which is private, but it's like universally considered like the best value-based primary care provider out there. He switched over to TOI in 2022. He was like, and I had this whole talk with him. He's like, this is the way it's supposed to go and whatnot. The most illuminating conversation I had with him is Keytruda comes off patent in, I think, 2028. And I asked them, I was like, what do you think happens? Do you think it's just a one-for-one immediate step down as biosimilars and generics step in? And is it going to go down? And they both immediately looked at me. They're like, no way. I go, so you're literally, they're like, oncologists aren't going to move that quickly. And everyone's going to play the game because it's over 95% fee for service. That they're like, maybe over 4 or 5 years, it's going to converge to the lowest, not even the lowest cost Keytruda, but like a lower quartile Keytruda generic. They're like, it's going to take years for that to play out. I go, so we could literally be making 20, 30% of the company's profits just on generic Keytruda versus the benchmark. And they're like, yeah.
I remember a long time ago, there was a roll-up I backed that was just like, hey, this was over in the UK, I believe, but it was basically what you're saying. Like, hey, you buy old brands after they're off patent. And this was like 10 or 15 years. And there's still some doctors who just like prescribe the brand and you've got a little bit of pricing power. It's not like the greatest thing in the world, but when you pay a nice multiple, it's like it's actually a royalty stream that's really interesting. Let me go back to some of the stuff.
Finish though for people listening. Just we talked story about it. Let me give you everybody the valuation number real quick, okay? This thing's trading at 0.7 times revenue. It's going to have zero EBITDA in Q4. It's been negative EBITDA. I think it's going to do $20 to $40 million of EBITDA next year. And I think you're building up to $75 million of EBITDA by 2027 exit rate. There's about 130 million shares. Net debt's about 40 million bucks. My target, I think this can go to like 2 to 3 times sales if you really believe in it, because the TAM is so big as they execute more states. But this is going to be, it's going to be time as people buy in. Street numbers are also insanely low. They've beaten and raised all year. So I think the street revenue number for 2026 is about 600 and change. Don't quote me on that. But you're going to get guidance coming up. And I think just mathematically, I think you still have a lot of upside on the annual guide. So I'm going to start thinking about this when it gets closer to 2 times revenue, if I'm so lucky. But I think there's just a ton of valuation room if this thing starts working. And I think the exit here is likely private equity. One of the private equity backed or drug distributor backed guys shows up and buys you.
It just worries me because this was the piss for all the value-based guys, and a lot of them did get taken out.
I know, but there's really no MLR risk. And it's also, like, to add, though, to your bear point, like, EVH really scared a lot of people because that was the value-based oncology name. And it's worth it for people to go through both. Like, EVH is not really that great of a business, like high customer concentration and whatnot. But anyway.
I'm going back to my notes from at the start of the episode when you were talking about launching Lake Cornelia. You mentioned pitching to a PM as a senior analyst versus pitching as a consultant, or maybe writing on Lake Cornelia. I'm interested. How have you seen people, work with you differently as a consultant, or when you write something up versus when you've kind of been the senior analyst or the head of research or whatever it is at places?
I think the biggest thing is when you're a consultant and like, look, I've done well enough in my career. So it's part of that too, where like, if people don't like the name, I'm just like, okay, great. Like, I'm not going to take it personally. This isn't my job. I don't need to I'm not upset about two things. Whereas, I'm upset that you don't like my idea, but like, okay, I got other clients I can pitch this to and I'll find another name. When you work for somebody, how many good ideas are you realistically going to come up with?
That's the tough thing, right? Like, you're an analyst and you're convicted, and it's why most analysts don't last forever with the PM, because you get one name, you do a lot of work, you get convicted. Hopefully the PM likes it, but if they don't, like, if you're a 10 out of 10 and they're a meh, it's really hard, no matter which way.
Exactly. You have this transmission problem, which is, and then even if they like it, they're going to buy it when you don't like. They're going to, they're not going to trade it perfectly. You wouldn't size it. And so you have it's a transmission problem of things that you would love to put in the book, where you would like to put in, how that actually happens, and then your compensation, as a function of the latter versus the former, and then I think it's something, Yaron's our buddy too, from one main capital. He did a great interview. I think it was like a month ago. And he made this point about going off on your own, that like investing is a deeply personal experience. And it's like art. And at some point you just reach a point where you just say, I want to do it my way. And that really resonated with me, because it's like, as I've gotten older, my willingness to sort of engage with people when they don't like something, I like having the veto of, oh, you don't like it? Great. I don't owe you anything. I'll move on to the next one, because what you want to guard against, and I think one of the other reasons why I love the Substack versus sort of how I was doing this before, which is getting high conviction, pitching a memo, and then screaming about something on Twitter, is you want to stay intellectually as open as possible. And the more debates that you have to like vociferously defend yourself, I think it's a negative, and it really impacts your ability to think clearly and cogently. The big decision I made going back in 2025, I mean, it was my decision of the year was I was very prolific and public on my feelings on Sable Offshore. And we got back involved a couple weeks ago. And we'll see how that plays out from here. That's certainly like, you could do 5 podcasts on that from here. But a name that I was very public on,
you can
start getting dicey. And I sold the whole position in the 20s. And I need to keep that ability to do that. And and
the way the news flow on Sable works, you could do a podcast on them every day. It's probably let me ask you a different question. One other thing you mentioned at the start, and this is something I've been thinking a lot about, having a small position and ramping it up as it inflects, right? And the reason I've been thinking about it a lot is because most of the big successes I've seen are very similar to what you think. I'll give one. My friend Jeremy Raper, right? When Twitter was getting suing Elon Musk to close the deal, I specifically remember there was something that came out in a court docket, and Jeremy was like, he'd been following it. He had a small position. I don't want to like give away his trade, and I could be misremembering, but and he was like, "This is the inflection. Elon is done. He cannot win this case," and he pulled the trigger. And like I just had that one in mind because it's Jeremy. It was kind of public, but the best guys I see do this, they're waiting, and then there's the inflection, and boom, they hit it. Right now, I do worry on the other side, like. It's very easy to see that and pull the trigger, but you know how it works. You're following a name deeply, and you see something, and you're just so convicted. There's a lot of selection bias, and also the guys who have seen blown up have been, "Hey, I see this. It's the inflection. Boom! I pulled the trigger, and you were wrong." So I guess I want to ask you, like, how do you weigh? Oh, this is the inflection versus, oh my gosh, am I just confirming my own biases? And it's very easy. I love this. Oh, all the news is positive. I was wrong, and it's a 0. So how do you kind of weigh that as you're looking for the inflection?
Well, look, the biggest defense against all of this is keeping a liquid portfolio. and retaining the ability when you're wrong to hit the eject button as soon as possible. Like, we're not burdened, you know, by a $15-20 billion fund. Like, I'll just go back. Like, the first guy I worked for, I mean, there was two of them who ran the fund. One guy did everything but run the money. One guy ran the money. But people would be like, "Oh, did you see the returns?" They'd be like, "Well, it's not that great." I'm like, "You try to run 20 billion at 14 net with 4% ball. Tell me how that works for you." It's like, you know, every dollar of AUM just gets exponentially more difficult. You know, for us, we're hanging out super liquid things. And I mean, I think that's important. I sort of mentioned sort of like with Twitter and with Substack, sort of, and you know, keeping myself as mentally open as possible. I think that that's a big piece. The second piece is at this stage, I kind of know I felt what it feels like to be right enough times. And so holding on and being like, okay, I'm going to get conviction. It's going to come. And if I don't have it, all right. Or if I do that and I'm wrong, you know, we can exit because it's liquid. I think, you know,
Can I just let me push back on one thing you said? You said a few times, if I'm wrong, I can exit because it's liquid. And I think I would guess that you are a much better trader and changer of your mind than I am. But like, Intelgo, I'm sure you don't know this, but this is a company that a lot of people I looked at deeply. I saw clear red flags, and a lot of people looked at it and a lot of them got out. You know, they bought in at 20, 30, it ran up to 200. A lot of them got out there. A lot of them got out at 100. But one day you woke up and, hey, the CEO's a fraud. The stock's been halted and it's going to open up and probably be a zero, right? And not an investing advice. I don't know. But I guess that's an extreme example. But you keep saying, hey, if I'm wrong, it's liquid, I can exit. I mean, sometimes you wake up to these things and you're wrong and it's not liquid.
If you have something, if you have something with downside jump in it, and like, you know, Sable's topic du jour, whether there's actually downside jump to default, as I would say in a CDX context, you know, or a risk arb trade that's got break risk, however you want to describe it. You know, when you're in names, you know, I'm going to remove fraud unless it's like fraud is clearly on the menu.
I just use Intelgo because it's a good, because the stock literally got halted. So no matter how good of a trader you were, you can't get out.
Certainly, like, it was out there that like, hey, maybe this guy's sketchy. It was a SPAC. Like, you had to like ascertain like at least a 5% chance of that, right? Or something with huge quarterly earnings volatility, like a consumer retail name, something where, you know, you really get in there and you're like, wow, most of the stock falls that quarter. So I think I would wrap that all into this, which is a function of being able to size something is directly related to your ability to ascertain and feel conviction on your downside outcome. That's it. And so, like, you think about, let's just start with Sable because it's topic du jour versus, you know, TE or TOI, right? Like you have to respect the fact that Sable, like maybe the California Coastal Commissioner or the governor of California, like, here's the menu of scenarios where you could wake up to, you know, down 25, down 40%, right? And like, that's realistic. And that has to impact sizing, right? And so as you're trying, like, think about it three-dimensionally, right? There's a few aspects to making a lot of money. There's the stocks that you like, right? And then you think about the total potential P&L in a year, right? From the price that you like it to the price that it goes. And you're trying to capture simplistically as much of that bar, be it horizontal or vertically. I don't care how you think, you know, pick one. You're trying to capture as much of the bar as possible. And it's like the whole Bernard Baruch or some other trader was like, you know, you miss the first 20, you miss the last 20, you capture the middle 60, right? And that's like, if you're doing it perfectly, that's sort of Steve Cohen too, as well, which is never try to call the bottom. The market will tell you and wait for a breakout. Okay. The second order aspect to that debate is sizing as well. So it's really not vertical or horizontal bars. It's really this cube, right? Now, the other side of that cube, you know, the potential P&L from $10 a share to 20, say maybe that's the range of the year. How big were you at 10, 11, 12, 13, 14? All the way up to 20. And then there's the downside, you know, below the iceberg, if you will, risk that you're taking, which really bleeds into portfolio management as well. So it's not just, are you right? So take TOI. I followed the name for 3 years. My probability of being able to ascertain and understand and correctly project it, is it in my circle of competence? Well, it probably wasn't at the beginning 3 years ago when I put the trade on. When I really ramped the thing up, I'm like, I think I'm right. My conviction level of me missing something is very high. Here's the bounded downside. I can really size this thing up. And so that all wraps up in one thing. And I would agree with you. Like, I've been guilty of this as well. Like, there's certain names you just can't size.
Let me ask. So we mentioned Nebius at the beginning, and for those who don't know, Nebius is the old Yandex. They basically, Russia invades Ukraine, Yandex gets force sold. They emerge, and rough numbers. They emerge. The stock's at, let's say, 18. They've got $15 per share of cash, plus kind of 3 startups that are worth anywhere from, depending who you ask, $0 to $100 per share, and they move into the data center business, right? That's one. So I just said $18 per share with $15 of cash. Now they will burn cash on the data center business, right? Now let's just compare it to the other far extreme, Sable. $1 billion of debt, loan to ExxonMobil. California government does not want them producing. If California government wins, they'll never produce. $1 billion of debt, it's a zero, right? One of the things I've struggled with, and I use those because they're two, we've mentioned them on the podcast, and they're two diametrically opposed. Like, how do you have those two in the same book? Because for me, like, I looked at a lot of net cash biotechs this year, right? Like trading below net cash. How can I have those in a book with literally anything else? Because on those, it's just like kind of a liquidation to cash play, very little downside unless management lights it on fire, which one or two of them, they did light it on fire. But, it's tough to do that. How do you have something with just such diametrically different risks in the same book?
Say both of those, if you say Sable in 2024, like we put the trade on actually in 2023 when the
we don't have to have it only be Sable and Nebius.
No, but I'll use this. It's a key point though, which is Sable in 2023. I bought the warrants at $1 pre-close, and for most of 2024 as well. I would argue the duration of the investment, whether you were right or wrong, was sufficiently long enough such that your downside was protected by vol. These are 100 vol scenarios, and this is where I was going back to right tail. If you are correct that people will care and the right tail potentially will be, the perception of right tail is big enough, right? So Sable, people were like, okay, if you're right, it's $100. The stock, was trading $15 before Santa Barbara settled with them on the valves in the summer of 2024. What is it? Just an option theory, right? Like they had enough cash. The Coastal Commission hadn't woken up yet. You didn't think you could die, but like if you were going to die, like you were going to die 2 to 3 years from now when you're sitting there in 2024. So like, what is that worth? It's worth a ton. And Nebius too, like that's what got me there, which was, okay, the sum of the parts is kind of helpful, but like, okay, if we play this out, these are the best data center guys out there. They're like execution Jedis. They have the best relationship with NVIDIA outside of any company in the United States. And people are, they're vetted by institutional investors and whatnot. And I was like, okay, this is probably, I was like, this is probably 75, how wrong I was. So it's sort of, a 10 by 75, but with 2 to 3 years of duration. Okay, so then, like, even if I'm wrong on the sum of the parts map day one, like, is it really going to get worse than 15? But this is where time becomes the enemy for you, and you have to be disciplined as well. This is where liquidity, right? So Sable did, struggled. It bounced off 33 times in 2025, but you got late summer after the GEC ruling, and nothing was happening with the fire marshal. All of a sudden, what you were leaning on in 2024, which was an option with massive duration and massive option
now
value.
Your theta is really starting to kick in.
It's really compressed. And so if you're not going to lean on valuation, traditionally, you have to at least lean on option theory, which comes down to right tail, potential, and then vol.
That makes total sense. No, it's a really, and I will say, I don't know if you're following the Warner Brothers Paramount Netflix deal. It's probably a little bit larger than the stuff you normally.
No, I have, yeah.
Yeah, I get a lot of people who are like, oh, how can you own Warner Brothers right now? Disclosure, I own Warner Brothers, I guess. But how can you own Warner Brothers right now? Like, there's antitrust risks. I'm like, look, there is going to be a discussion on antitrust, and we can have that. But in the next 30 days, you're not going to get a DOJ or FTC ruling. Actually, the only one you could probably get is positive if they cleared Paramount. You're not, like, that's a conversation for a different day.
I would go further with this point for people, and I bring this up. Like, so after I left Distressed Dead, I went to a big pod shop. They relaunched their event-driven group. I was the non-risk arb guy on the risk arb team, so I got to see a $4 billion risk arb book. And like, this was right during Abby Shire and the inversions and whatnot. My team spun
Oh
out.
boy, what was it? It was the what was the inversion apocalypse? There was two of them. One of them was Pfizer
Abby
Allergan.
Shire, I
What did we call
remember.
it?
And then I'm not going to remember the other one. If you
It
said
was
it,
like
it's another drug company.
it was Pfizer Allergan, I think, and it was Armageddon or
Yeah.
like
Yeah.
yeah.
Allergan. But then my team launched, a hedge fund at Newberger Berman. They're still there. It's not my team anymore. I went to 2020. But I got to see, 7, 8 years of risk arb. I think it should be mandatory for any event-driven investor to study the Acorn broken merger. So Fresenius,
Oh, I
um,
know this one. Yeah.
Fresenius, this German company, was buying Acorn, this generic drug company. Okay, they sued over a MAC, material adverse change. It was going to Delaware court, and nobody wins on a MAC. Now, it did kind of look like Acorn lied. Like their facility didn't work. The stock was like 10, like I think the takeout was at 32 or 33
Yep.
bucks all
Yep.
cash. The stock was 12 bucks into the trial. And you had this 25-day period before the trial started. And the stock went from, 11 to 12 to 18 during those 3 weeks. And you talk to people, and by the way, Fresenius won, Acorn was 0, it went bankrupt. But to your point, and this is sort of on downside risk and narrative, right? This is everything. Everybody, it was the most genius trade watching that thing unfold because the people long it, you had a lot of people were short, and all the long guys were like, everybody's short. You can't die before the trial. There's a trial. I know. And the thing peaked a day before the trial started. The stock peaked, and it went from 18 all the way down. But they're like, 30. Do your probability weight 33 versus 0. People.
I also don't think people thought it was a 0-0 at the time, right? So I don't think people thought that. And look, until the trial, like the company's always going to, especially a company that bad, they're always going to risk it for the trial, right? They're always going to take that risk. And heading into the trial, you mentioned peaks the day before, because guess what? There might be a settlement, right? Every other MAE, like Acorn Fresnius is so interesting because every other MAE case has basically settled because even the buyer knows, like, hey, we wanted this strategically, right? So if we can get a price cut, the seller generally knows things aren't great if they're getting sued. So there's generally a lot of room for a cut. Acorn's the unique case because they were supposed to be running clean rooms and there were cockroaches running around the clean rooms. Like that's the one unique case.
And it's just a fact. So, timeline and monetizing and thinking through an option that, like, all this stuff, it comes together. And like the more it's one of the other lessons, which is you can, why do I write, going back to the Substack, why do I write a collective, I wrote about eBay, PayPal. People were like, why are you doing that? I go, because in everything there's a lesson. And you don't know where the lessons are going to come together. And being free to explore is just, it's so fun. Going back, to Warner Brothers for you, I looked at it, I put on some Netflix. I took it off because other stuff was more exciting. But like Netflix is super, where's it now? I haven't even checked.
Let's go pull up the handy Bloomberg. It's 90.
I mean, Netflix is super interesting to me. They free cash flow finally inflected. The thing's pooping cash. You had a negative guide into it that, on a single stock basis before the deal happened, right? You had a broken bull story that looks very secular to me. Then you have this, which is like, even people long at the long only community throws up their hands, which is, is Netflix going to raise their price? And if they don't raise their price, the stock's going to be in merger purgatory for 2-3 years. The best I could hope for is T-Mobile during the Sprint merger, which I thought was going to be in purgatory for 18 months. And actually the stock T-Mobile did very well, but like that is an outlier of an example of something facing regulatory risk that works. So if you're long Netflix, what you're really rooting for is it completes on, your existing terms. That would be, resolution would be helpful.
Yeah, if you're long Netflix, you're hoping Paramount comes in 34. Warner Brothers writes you
the
a
best
$5
thing that
billion
can happen
check.
is you lose and they don't raise. The second best thing is you complete the deal on your terms. The worst thing that can happen is they bump and then they take on a bunch of debt.
From a Netflix perspective, I think it's interesting because, they did have soft earnings, but I do think They bought Warner Brothers and they've never bought anything, right? When this came together, when this all, I kept telling people, man, Netflix has bought one thing in their entire history, right? They bought that small comic book publisher. These guys don't buy anything. They're not going to buy Warner Brothers for, rounds to $100 billion. No effing chance. They bought them. They won. And they, it might not have been the best bid, but it was very close to the Paramount bid. Warner Brothers thought it was Spear, whatever. I think Netflix is going to have a little bit of taint on them for the next couple of years, just in terms of investors are going to wonder, hey, what was Netflix seeing in their business that they needed to go buy Warner Brothers, right? And now Netflix is going to say, hey, great synergies, we can run it the best, all this sort of stuff. And they're probably right. But I think investors, whether they buy Warner Brothers or not, for the next 2 years, I think investors are going to be saying, well, what was Netflix so worried about that they needed to do one of the largest M&A deals of all time from this company that does everything organic?
Fair. I mean, I think that's kind of the thesis from 110 to 90 on the way down, because you had the earnings miss into this. And I think that's where I was sort of getting at, which is, if they don't screw up, or if, they lose and they walk, that would be great. I mean, I think the other side of it, which, who knows, the synergy number looks really juicy to me on the low side from Netflix. Only $2 billion of synergies seems exponentially low. So I think Netflix is really hurt more on just the potential merger purgatory. It's interesting. My problem with risk arb since I've left hedge funds, though, it's like I go through this once every other year. I feel like I find myself in a merger arb situation. I'll put on a position, and then 2 days later, I'll remind myself, I don't need to do this anymore. I don't.
Yeah,
I'm just going to find the gross stuff.
You do it and you're like, oh, cool, I'm paying for 10% upside, 15% upside. And then you're like, oh, if I, hit
it up against the smartest
biotech
people. Everyone's you got to look at 100 of these situations to find something fall out. And it's usually the weird thing that falls out. And that's why I'm sort of fixated on Netflix, because these three-way mergers, they start pricing weird things. And I think most people sort of get that.
Netflix, the other thing, I mean, I've got, again, big position in Warner Brothers, but they're so big. I do like everybody says when something really big happens, like, hey, there's not enough risk arb capital in the world to close the spread. And I've never seen from Warner Brothers, when I was putting this on, I've never seen a stock get a $30 per share topping offer hostile bid. And the day it came out, it was trading at 27. I've never seen a company in a bidding war trade below one of the cash bids, which is what I thought was so interesting there.
Agreed. And then they went hostile. I mean, it's just the political. I mean, it's a fascinating. We haven't seen this, I can't remember the last one that was really.
We had Pfizer, who was bidding them in Metsera. I mean, literally just 2 months ago, we saw that. Was it Nova who bid against them? I can't remember. But before that, it had been a while. Maybe Disney, Fox, Comcast. But okay, we're way off topic. Judd, this has been great. We're gonna have to schedule a follow up because I have 15 questions and notes on Caesars in Vegas that we're not going to be able to get to today. But this has been awesome. I'll include a link to Lake Cornelia Substack in there. I was a pretty damn early subscriber, and it's fun reading all the eclectic stuff and everything. But Judd Arnold, Lake Cornelia, thanks for hopping on, buddy, and I'll hope to see you soon.
Have a good one. Thanks so much.
A quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.